The current portion of long-term debt should be classified as a current liability. For instance, if you've got a 5-year car loan, the portion of that car loan that you're going to repay within the next 12 months would be classified as a current obligation. The part that you're paying in the years 2 through 5 would be classified on the balance sheet as a long-term obligation. So, formally, the portion of bonds, mortgage notes, and other long-term indebtedness that matures within the next fiscal year is classified as a current liability. There are exceptions to this, however. We will exclude debts maturing currently if they are to be retired by assets that we've accumulated separately and those assets are not shown as current assets. For example, we've accumulated assets in a sinking fund, and those are classified as long-term assets on our balance sheet. If we're going to use a portion of those long-term assets to retire this debt, then we would continue to classify the debt as a long-term liability. A second exception would be debt that's going to be refinanced or retired from the proceeds of a new debt issue. We'll take a look at this one a little bit further later on. Or 3, the amount will be converted into capital stock. For instance, if we have convertible bonds, and it's likely that those convertible bonds will be converted into common stock by the debt holders, we will continue to classify that debt as a long-term debt. Let's go back to number 2 now. If we have short-term obligations that we expect to refinance, and that could be a short-term obligation in its entirety or a portion of long-term debt that we expect to mature next year and refinance, we will exclude these short-term obligations from current liabilities if both of the following conditions are met by the balance sheet date. The first condition is a little bit lame. That is, the liability is contractually due to be settled more than 1 year after the balance sheet date, which to me makes it sound very much like it is contractually a long-term liability, so we would exclude it normally from current liabilities. The next one, though, is the one we're a bit more interested in, and that is that the entity, the company, has a contractual right to defer the settlement of the liability for at least 1 year or operating cycle, whichever is longer, that goes beyond the balance sheet date. It's important to note that this contractual right or contract must be entered into by the balance sheet date. So, for instance, on January 5th, we enter into a contract to renew or extend the maturity of some short-term obligations for 2 years. We're still going to classify those as short-term obligations if that contract is entered into on January 5th. However, if we had entered into that contract on December 8th or 28th before year end, that we did have the right sometime in the next year to extend this beyond 1 year or operating cycle, then we would classify it as a long-term liability. So that contractual right has to exist at the balance sheet date. Let's go ahead and take a look at an example. The controllers of Metlock and Sarasota both ask you whether their companies can reclassify short-term obligations as long-term obligations. Here are facts surrounding the company's short-term debt. Metlock, on December 31st, 2020, has $2,080,000 of short-term debt in the form of notes payable that are due on February 5th, 2021. On January 28th, Metlock issued 20,800 shares of common stock at $75 per share and used the proceeds of $1,560,000 from the stock issue, along with $676,000 in cash, to retire the short-term debt associated and the associated accrued interest on February 5th. Metlock will issue its year-end December 31st financial statements on February 25th, 2021. The question is, how should Metlock classify this on their balance sheet? Metlock will classify the entire $2,080,000 note payable as a current liability. And the key problem is the contract must exist by the balance sheet date and at the balance sheet date. So at the balance sheet date, that contract must exist. And we clearly see a contract did not exist. Metlock didn't issue the shares until January 28th. Let's go ahead and take a look at Sarasota Corporation. On December 31st, 2020, Sarasota has $3,120,000 in short-term notes payable. The notes are due January 31, 2021. Sarasota retired the notes along with $208,000 in accrued interest in full on January 31, 2021. On February 11, 2021, Sarasota obtained $4 million in long-term financing from Terre Haute Bank. The new debt bears a 5% interest rate with interest payments due annually. Sarasota will issue its financial statements on December 31st, 2020. And on February 28th, 2021, both the interest payable as well as the face value of the notes should be classified as a current liability. So the $208,000 in interest payable is a current liability, as well as the entire $3,120,000 in notes payable. Again, to be classified long-term at the balance sheet date. So as of December 31st, a contract must exist to extend the due date for a year or more beyond the balance sheet date.